I have been seeing a statement recently by several people on my feed sharing the high oil prices for the move to renewables and upcoming end to big oil companies eventually. Though I understand this sentiment, it doesn't cover the ground reality. It is important that people should think this topic in a strategic manner, as energy has a far deeper impact on global economy potentially than any other factor over a longer period of time. The common wisdom says that high oil prices create better incentives and price points for renewables, which is true. But it doesn't imply that it also changes the status quo in the emerging renewable markets and what kind of mix will be included in the renewable or low carbon energy sources. We broadly consider renewables as solar and wind energy. And with the drop in cost in both sectors, it is touted to be the cheapest source of energy by the end of this decade globally. In a few areas, it's already quite competitive. But for a deeper understanding of the dynamics of energy and high oil price implication, we need a better framework than plain vanilla statement like high oil prices create a better incentive for renewables. I was surprised to see that people managing billions of dollars in asset under management casually treat it and barely understand it at times. This is also a topic that I have certain expertise and certain authority as well. I have spent 18 years in energy, primarily in oil and gas, for 15 years and later moving to wider energy practice with Boston Consulting Group. I spent my time with many companies, regulators facing the same question and helping them to formulate ways to navigate and embrace the energy transition. It's also important for the audience to understand my views on energy transition as there is no way to discuss it without certain bias. I believe in energy transition as an existential requirement for the human race. We should treat it as a crisis and we should use every piece and resource to achieve it. In the last decade, oil and gas industry collectively has destroyed shareholder value in a time when the rest of the industries has gone strong and indexes appreciated considerably. So despite being one of the most essential commodity globally, why has industry destroyed value? The reason for this question somewhat lies in the executives' blind spots and the controlling nature of the industry. See, in 2007 2008, several key technologies like direction drilling and fracking for shallow to mid depth well drilling became mature and, in most cases, quite cost competitive in many ways. At the same time, SEC updated the rules for reserve certification and included a section of reserves that can be added based on the data provided by certain new technologies. This added with the immense liquidity with quantitative easing by US government following the financial crisis created a perfect storm at the time when world needed more energy, USA was a net importer and renewables were at the distant horizon. An output of this was the rise of shale industry, which for a brief period led to US being 100% self-sufficient for its oil and gas energy needs. In the early part of the shale rise, it was looked on by many executives by their own admission in coming years as they saw an industry that is using technology in somewhat gross way in their view and producing oil and gas at a higher price range than one produces from conventional oil and gas field. The common view was a disorganized industry using crude technology to produce oil and gas at almost 60 to 100% higher cost above the conventional industry is a blip in the oil and gas industry and not to be considered seriously. Also, the definition of disruptor includes that they often start with low quality solution at a far lower price. So this was a low quality solution for them but at a higher price. So there was no cause for worries in plain sight for them. Remember, all major companies, including global powers, were left blindfolded during the early rise of shale oil and its impact on geopolitics in the coming days. While executives were focused on the higher unit development costs of the shale oil and writing it off, they completely misunderstood the cash cycle of shale oil. You can get a cheap rig and fracking unit and lock pricing. You can also sell oil futures in some capacity to hedge the prices in windows of higher prices. You can raise loans almost at no or little interest in quantitative easing pumping era. And you pretty much lock up decent profits in short time. All you need to do then is to drill and produce and knowledge of it spread quickly. It became a movement in the USA and regions like Permian and Bakken. While the margins of shale industry was far lower, The maximum cash exposure on the project, field development, project cycle and execution, and path to first dollar and break even was also lower. So due to these elements, the opportunity cost for shale oil project was very different from a large deep water development project that takes 7 to 10 years before a single barrel is produced. By the time large oil and gas companies and executives realized it, it was already out of the hand of those who could control the price of oil by a single statement. The industry was rising so rapidly that industry hasn't seen this kind of rise for a very long time. And it was not easy to raise the production of oil via conventional oil and gas field with coordinated effort, even if they try. This created the bubble in oil and gas supply as we reached the end of 2013. I visited Pittsburgh to present a technical paper in June-July 2013 in American Annual Petroleum Geologists Conference. And the city was abuzz in complete euphoria and everyone was calling it a shale oil conference. And it was validated when the conference started as 90% of the conference from my estimate was shale oil papers and discussion. The executives were spending top dollars by now to buy shale acreage in rush and without proper due diligence. Oilfield services companies were figuring out technology development to join the gold rush. But as we have seen it, it all soon came down between a major showdown between shale players and OPEC Plus starting mid 2014 and slowly plunged the oil and gas industry into a downward trajectory for next few years. It created a unique dynamic in the industry, the likes of which no one has seen before. Under 45 to $55 barrel, OPEC Plus had control on how to dictate oil prices. And as soon as it rises higher, shale players had the better incentive and they can produce without anybody's else control. Oil price is what we call is inelastic price. So marginal change in supply and demand can send prices up or down a lot. This combined with the rise of renewable predominantly solar and wind created another storm for it. Also the rise of EVs and countries' strategic priorities to use rise of renewables and EV as an opportunity to change the global trade status quo created another dynamic. The sentiment peaked when the world went standstill at the onset of COVID-19 and it bottomed the oil market with WTI futures reaching negative price in March-April 2020. Years of bad decision making, cash burning, and price collapse, increased commitment on climate transition forced executives to rethink and reshape the strategy. This over time has led to serious underinvestment in oil and gas, and shale players also have struggled with the change in policies and decline in some key bases in terms of productivity. And all of this slowly handled the control back to the OPEC Plus in terms of managing oil prices. But one thing has changed in the meantime. Big oil has now decided to become big energy. That is, almost all of the major oil and gas companies now have renewables and low carbon business units, and it is now flooded with cash. Something they have been deprived for the last few years. Also, with a commitment to net zero, they are back in favors in many circles. Big oil has many advantages in terms of capabilities over traditional renewable companies. Extensive mega capital project experience, key capability for large scale renewable projects that industry lacks. And if you would see the project managers of these projects today, a majority of them came from oil and gas industry. Big oil has always better integration with global powers, governments, and overall global footprint. The global presence of pure renewable industry at this point at best is regional. Big oil has extensive networking and ability to raise cash from financial institute, significant campaign funding history. In addition, most of the time they hired some of the best talents, extensive cutting edge research on wave equation, diffusion equation, pressure equation, and their applied application on many complex engineering applications. Many problems that are critical for expansion of large scale renewable actually have expertise in oil and gas engineering, most notably in offshore wind and upcoming floating offshore wind, a sector that will be dominated heavily by oil and gas engineering and its offshore experience, and it has already become favorite for many EU oil and gas majors. There is something else that is best known as transatlantic divide in energy. That is, majors on each side of the Atlantic has taken the different course for low to no carbon world. While European oil and gas majors have adopted the renewables as mainstream and eventual commitment to net zero and transition, US oil and gas majors are focusing more on low carbon technologies like carbon capture, utilization, and storage, commonly known as CCUS. It's very strategic as the technologies and nature of operation is very similar to oil and gas operations. So, as long as CCUS is characterized as low carbon, it will have access to green financing. Oil and gas has all the technology and project experience to execute it as soon as it is required. We saw the subsidized pricing of the development of Northlight project in Europe. CCUS is one technology which is globally pursued by almost all countries in some capacity as low carbon solution and only technology pursued by oil and gas major across the Atlantic despite the Atlantic divide. Subsurface or underground sequestration based storage is a technology for which all the required parts exist solely in oil and gas industry and years of expertise that can be adapted for its scale up. There is something else which is not discussed in public forums, and you know only if you have actually planned or executed these projects. CCUS is applicable for green financing in many places, but in reality, the nature of operation in oil and gas fields are complex. And in the most field, conventional oil and gas operations, drilling, gas production for blue hydrogen, and CCUS have strong synergies. So, a well planned project will access green financing and will be able to indirectly subsidize the cost of oil and gas production as well, which already has achieved significant cost competitiveness during the last year's decline. In a high oil price scenario that is resulted due to OPEC plus tight control on production, the decline of US shale oil, and years of underinvestment, and with the reasoning I just shared, provide a perfect cash generating opportunity for big oil, and this cash will ensure they eventually move to big energy with their global dominance over more or less intact with only few changes in the status quo as it exists today. When the oil price was low, oil and gas companies were fighting bankruptcy and cash crunch, and many new renewable companies had the opportunity to rise. But it's very likely, and we have seen evidence of it, that cash rich oil and gas companies will buy many of the renewable, and rest of the companies which they don't buy may not be able to compete. Also, with intent to move to net zero and low carbon world and loaded with cash, project management, talented engineering workforce, global presence, cutting edge technologies that can be adopted for renewables in many circles, it will even expedite scale up and move to renewables and low carbon technologies and help in bringing regulatory framework for critical elements like carbon trading and carbon tax in many parts of the world. However, the plain vanilla view that high oil prices is good for renewable is not true. It's good for both oil and gas and renewables, and definitely good for big oil in its pursuit to big energy. It allows them to shape renewables and low carbon narrative better, and which means that the role of blue hydrogen and CCUS will be far bigger than climate activist has assessed. As I said, that we can use any help whatsoever is needed and available in the fight for climate transition, so it is likely that both parties will eventually figure out how to work together for a common goal. It's bad news for those who are hoping the imminent bankruptcy of oil and gas companies due to energy transition. The mix of renewables and low carbon technologies the world will pursue in the era of high oil prices is going to be very different relative to the world of renewable technologies in low oil price world. So considering a plain vanilla approach on this topic is naive, and it could also hurt your investments and plans. Also, energy is a critical element in inflation. High oil price will always be a tailwind for high inflation, the meaning of which we already understand better with each passing day in life and investing impact. I have a master in technology and applied geophysics, postgraduate diploma in ecology and environment, postgraduate diploma in petroleum engineering, and an MBA, in addition to a bachelor's in maths and physics. I have worked in large scale numerical modeling projects, mega capital projects, digital strategy in energy industry, and worked with many regulators over my career. I'm perfectly capable to frame and work technical project and business problems in the field of energy. So I would request you all that energy is the biggest force and driven by a strong narrative in many ways. Things are not as simple as they seem, and it's not time for us versus them. It's time to fight climate change, not each other. What I discuss in this video is sensitive to many, and if I may request, take a step back and think about it. It might give you a couple of additional perspective. I don't invest in oil and gas companies and energy companies as I have been under NDA and confidentiality agreement for most of the times in last years. That is due to my access to information that could be considered as insider information, and I don't plan to do that until my NDAs and confidentiality agreement expires. Please be advised, the purpose of this video is to educate and teach tools on how to deploy strategic thinking on business and investment problems in an outside-in manner. All contents are presented for education, information, and entertainment purpose only, and no portion of this content should be used as financial advice. Please do share your feedback in comment section, and if you enjoy the content, do like the video and subscribe to the channel. See you next time. Goodbye.